Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. In this episode, we are talking about two very interesting investment areas, the exciting, the high-growth Max 7 stocks and the boring, established dividend growers. Joining me today will be Dave Maza, Chief Strategy Officer at Roundhill Investments. But a quick programming note before we start the interview. The show is going on a mini hiatus as I'll be out of the country for about 3 weeks, but we'll be back with more interesting topics and expert guests after that. And while I'm gone, please catch up on the past episode that you might have missed earlier. Okay, let's talk about the Max 7 stocks and dividend monarchs with Dave Maza. Hi, Dave. Welcome. Great to have you on the show.
Hey, thanks for having me.
So the Magnificent Seven stocks, they had accounted for more than 62% of the S&P 500's total return in 2023. And most experts had anticipated a broadening of the market rally in 2024, but it appears that that hasn't happened so far, right? So do you think the Magnificent Seven can remain magnificent in 2024?
Well, I always think it's difficult to make a prediction, a accurate prediction, or even have sort of great clarity on what an entire year looks like. But if I had to do so, and if I had to hone in at least on sort of the first half of the year, I would say the momentum behind the Magnificent Seven and sort of mega cap tech in general and profitable companies in general remains firmly in place. And a lot of the reason for that is not just around the hype of AI. And I think it's important to disentangle this. That's a big driver of why there's excitement around companies like NVIDIA and companies like Microsoft, and now more recently what Apple may be doing there. But it really is the fundamentals. So while there's been extreme concentration that we hadn't seen in some time, what's different in this scenario is that these companies are growing their sales at significantly higher rates than the 493 other companies at S&P 500, let alone what we're seeing and not seeing, or sorry, what I should be saying is what we're not seeing in small caps.
Right. So you alluded to the AI hype. So all these companies, all these stocks benefited a lot from the AI hype last year, but it appears that investors are now trying to figure out which of these companies will be the actual beneficiaries of the AI bonanza. So you mentioned Microsoft and NVIDIA. NVIDIA is, of course, the most obvious winner. So that is why we have seen these divergent performances in 2024 so far. And this divergence has kind of expanded in the past few weeks when these companies reported their earnings, and only NVIDIA is yet to report. So as of now, NVIDIA and Meta are leading the group. They are up about 52% and 41% respectively. And we are recording this on February 16th. And Tesla has significantly lagged the group. It is down more than 15%. Meta's results in particular were very well received by the market, by investors. Shares surged more than 20% after they reported. And Tesla has been punished for missing both earnings and revenue estimates. NVIDIA reports on February 21st. And in fact, it seems that the market rally now hinges on NVIDIA's earnings. Those earnings may determine which way the market goes now. But the stock is already up a lot. So I was interested in your thoughts on recent Max 7 earnings or Max 6 earnings. Which one impressed you the most?
Yeah. So if we think about the group as a whole, 6 of the 7 companies, to your point, have reported. And rightfully so, people are considering, well, what could be next because of the stellar performance. Only Tesla of that 6 so far missed the consensus estimates for revenue growth. And if we look as a group, including all 7, they're expected to generate sales growth of 14% year over year this earnings season. And the 493 is a more modest 2%. What I think is also more remarkable is that these market heavyweights are seeing much higher margins. So 23% versus 9, and they're growing them at a faster pace in the broader market. So about 7.5% versus negative 1.1%. So as a whole, again, absent Tesla, which I think was impacted by the cyclicality of their core autos business, earnings seasons have been good to great, depending upon your perspective. Now, I think NVIDIA, of course, has lofty expectations. They have shown a propensity to beat those lofty expectations. At some point, though, because of the recent parabolic move higher in the stock, I think we may be due for a bit of a sell-off, just simply from that point of view. But what I thought was interesting was that if we think about this earnings season, Microsoft in particular is notable because when we think about themes like AI, many times they are expected to occur years or decades in the future. But now we're seeing a bit of a broadening out of companies that are making money off of AI today, right? Again, not decades from now. And, Microsoft showed that among other names. So I thought that was a notable takeaway from their earnings report.
Yeah, earnings in general have been really, really impressive. Now let's talk about your ETF, the Monarchs ETF. This has seen a lot of interest from investors, of course, because of the magnificent performance by these stocks. So this is not even a year old, and it already has about 140 million in assets, as I'm checking. And this was actually Big T ETF earlier, with 5 big technology stocks. And then you decided to change it to Max. So tell us a little bit about that change and what it currently holds, why equal weighting, and other details.
So you're right. The Magnificent 7 ETF MAGS started its life last April as the Big Tech ETF, Big T. And we heard some feedback pretty immediately from investors to say, hey, I love this concept of creating a precise exposure. But really what they were focused on at the time was, well, how about Magnificent 7? And so we actually modified the fund in November of last year to include all 7 Magnificent 7 stocks. What we do when we manage the portfolio is on a quarterly basis, equal weight the names. So it is not market cap weighted in that regard. And the fund offers that precise exposure to just those 7 names. And I think what we have heard from investors is that, of course, you can get exposure to these names, or you have exposure in probably nearly any index fund to some way, shape, or form. But increasingly with ETF investing, we've also heard that folks are looking for the precision. And if you're investing in the S&P 500 or NASDAQ and you really want that overweight, you're going to have a lot of dilution with that. And that's one of the reasons why I think we've seen most recently some pretty strong growth in the Magnificent 7 ETF.
Yeah, you're right about precision in exposure. It holds just those 7 stocks. But one question that I often get from investors when they look at these ETFs, which provide very concentrated exposure, that why not just buy the stocks? Because so many broker platforms now offer the convenience of fractional share trading. So why not just buy those 7 stocks, or why not just buy the 6 stocks? Because Tesla has been a drag on the performance. And also, why equal weighting? Why not just go with market cap weighting for these stocks, go with the market wisdom again, as I mentioned, Tesla has been a drag because of equal weighting. Though, if I look at the exposure currently, it seems that NVIDIA accounts for about 18% of the portfolio, and Tesla is a little less than 10%. That is mainly because of its underperformance, and they will be rebalanced at the time of quarterly rebalancing, right?
Yeah, no, you're absolutely right. So if there's an individual or an institution, perhaps, who wants to kind of make a selection that says, "Hey, I think Apple's stock, for example, has been a bit soft, and their AI solution that is likely coming this summer is going to be really groundbreaking. I want to have that individual position. By all means, that makes sense to me. But for an investor who wants the convenience of an ETF, even though it's 7 names, at least I know from my experience, as best as I try to, sometimes behavioral biases can come into play, right? Winners get too large and maybe losers get too small. So the equal weighting and that quarterly rebalance brings that back into line. And then you have some of the benefits that can come with the ETF structure. And so there are, to answer the other part of your question, is that there most recently has been some conversations, particularly about Tesla. Does it really belong in the group? And if you look at its short-term performance, it certainly has some large dispersion with some of the other winners. But I think the same has been said about names like Meta, and people count out some of these companies. But to me, I think we remain in a haves and have-nots world where the largest, most disruptive companies that are led by folks like Elon Musk or Tim Cook, in that example, are winning, and those companies that are not profitable are having some more challenges. So time will tell, of course, if any or all of these companies remain magnificent. But for the time being, I think the momentum is there, and the ability to have that at least diversified among the 7 exposure could be beneficial.
All great points. So these companies did not outperform just the last year. They have actually been leading the market for over a decade now. And this surge in these high growth tech stocks, combined with ultra-low interest rates, that has diminished the appeal of dividend-paying stocks. But over the longer term, if you look at the longer-term performance, then dividend growers have also done quite well. And because of the underperformance last year, investors kind of lost interest in these stocks and ETFs as well. And dividend-focused ETFs took in very little inflows last year. It was the lowest amount on record. So do you think dividend investing can finally make a comeback in 2024?
Yeah, it's really fascinating. I actually, earlier this year in January, published a blog on our website called Dividends in the Doghouse. And you're absolutely right. The flows into dividend ETFs in 2023 were incredibly lackluster. They saw about 1.6 billion. The average of the last 20 years has been closer to 13 billion per year. So as dividends are just an area that investors allocate toward and are interested in. However, dividend paying companies, particularly dividend growers, have not been rewarded by the market. Last year, the Dividend Aristocrats Index, which has a lengthy history, saw some strong underperformance. Some of the, actually underperforming the S&P 500 by over 26%. That's the worst one-year performance it's had since 2000. And a big reason for that is because there's no exposure to the Magnificent Seven, or minimal exposure, I should say, to those names. And the market was not rewarding what historically has been stable companies, and they've been really paying up for growth, sales, and margin growth, which dividend paying companies don't always offer. Now, on the flip side, I think we had noted earlier in the conversation that for the time being, the Magnificent Seven, I think, remain in the driver's seat. But if we enter in an environment where either we begin to have clarity on specifically when rate cuts are likely to occur, or we get into an environment where volatility increases, perhaps due to the election and what will likely be a contentious political season, then I do think the market will probably reassess and say, wait, maybe we've been a little bit too harsh on some of these high quality, long standing companies that have not been in favor, but certainly could be when it comes to looking for stability in portfolios.
So your new ETF provides exposure to companies that have consistently increased their dividends for at least 50 years. That's really, really impressive. So the ETF is the Roundhill S&P Dividend Monarchs ETF. Ticker symbol is Kings, KNGS. Please tell us a little bit about this ETF and why you decided to launch this ETF.
Yeah, this was an ETF that we were really excited to be able to bring to market and partner with S&P on, who developed the index. And what it does is it takes the well-known concept of dividend aristocrats, and so these are companies that have each and every year increased their dividend to shareholders by 25 years, and focuses just on those names that have done in the U.S. market that have done so for each and every year for 50 years. And so the group of companies that have been around for 50 years is small, let alone those that have been able to increase their dividend to shareholders. And so there are 36 names in the portfolio. Compared to the aristocrats, interestingly, you get a slightly higher yield, but that comes with a similar price to earnings ratio, but stronger return on equity and a lower dividend payout ratio because again, you have a smaller number of companies, so that 36 versus about 100 or so, and these names have seen it all. They've been through wars, recessions, everything in between, and they've been able to consistently reward shareholders along the way.
Yes, excellent. So these are the companies that have endured more than half a century of all kinds of turbulence, market ups and downs, and consistently generated a lot of free cash flow to pay and grow their dividends. So could you talk a little bit about the profitability, the longer term profitability and financial resilience of these companies?
Yeah, so even though dividend growth companies and dividend aristocrats and dividend monarchs were not rewarded by the market in 2023, or perhaps you'd say even somewhat over a longer time period. If you look at very long time horizons, these are the companies that have proved to be incredibly resilient and have generally high quality characteristics that make sense for investors who are interested in having a higher than market income, but significantly actually lower volatility and just robust sort of balance sheet strength to get through all of these difficult times. And so in a market that's rewarding either growth at all costs or growth of margins, growth of sales above everything else or above multiples, then these companies would underperform, but over the very long term, they have, investors should have confidence that they have strong performance potential. And then if you actually look at, if we compare the valuation of the Dividend Aristocrats Index, which has a longer history than Monarchs, and frankly, the Monarchs index only has a shorter history because, again, there hasn't been that many companies that have been around for 50 years. We're at multi-year lows in the relative valuation. So for investors who are saying, "Hey, I think the market I may be willing to maybe getting a little bit frothy, or there's potential to reallocate," perhaps just looking at small caps more broadly, which do have a profitability problem, investors may start looking at this as an opportunity.
So one concern which some investors may have with this kind of strategy is the lack of exposure to the technology sector. because we know that technology companies are growthier companies. They generally do not pay a dividend. Now, some of these companies have started paying dividends in the past decade or so. For example, Apple restarted paying a dividend since, I think, 2012 or 2013. Microsoft has been paying a dividend for many years now. NVIDIA also pays a dividend, though the yield is minuscule because the stock price has gone up so much. Beta started paying dividend. They just announced a dividend recently with their quarterly earnings release. And the technology sector has, as a whole, it has become one of the market's largest sources for dividends because of the sheer size of these companies. So what do you think about lack of exposure to technology stocks in this kind of strategy?
No, I think that is if there's a reasonable area of pushback for someone who's not interested in it, I understand where that's coming from. For example, the Kings ETF, Dividend Monarchs, has zero exposure to technology as a sector at a whole. Now, there are other indices or approaches that maybe have shorter time horizons for identifying dividend initiators or dividend growers, and you might find that there. But again, if the objective is to identify companies that are kind of less well focused on today, or not where all the attention is, then I do think an approach like Dividend Aristocrats or even Dividend Monarchs now with Kings can be beneficial. So that is a reasonable point. It is 100% true. However, if someone is looking to say, I really want the stability, I actually have so much exposure to tech or other areas, this could be a way to diversify away from that.
I'm going to put you on the spot now, sorry. So if you had to choose between these two ETFs, Max or Kings for 2024, if you could put new money in one of these ETFs, which one would you select? And again, we do not make investment advice on this show. So I'm not asking for an investment advice for our listeners, but just interested in your thoughts.
Well, it's like picking your favorite child, but what I would say is, and maybe this is a cop-out, but it's really about time horizon. So if someone is more active or looking to maybe continue to see where some of the momentum in the market is, then MAGs I think is very reasonable. And again, I think until we see a material change in the economic environment or interest rate environment, it's going to be hard pressed to see any companies away from the giants to really be rewarded. But if someone is saying, "Hey, I have brand new money. I really want a set it and forget it approach with companies that have been incredibly resilient," then Kings makes a lot of sense and perhaps more sense. So, not to try to have a cop-out answer, both can make sense depending upon people's objectives.
Fair enough. So I also wanted to talk a little bit about your newest ETF, and this combines two of the hottest investment themes in the ETF world, Bitcoin and covered call strategies. So the ETF is YBTC. It is the first US listed Bitcoin covered call ETF. Tell us about this ETF.
Yeah, no, we were really excited to bring YBTC to market because it combines, to your point, two strategies that are of great interest with investors. It's exposure to crypto and in particular Bitcoin, combined with exposure to covered call. And we essentially what the strategy is it provides exposure to the price of Bitcoin subject to a cap. And has the potential to generate high income, of which investors are focused on today. So I think for investors who are interested in diversifying their portfolio, but maybe concerned about the volatility that an individual allocation to Bitcoin could provide, a strategy like YBTC can be attractive for them. or conversely, if someone believes that crypto may be more range bound than we've seen for the rest of this year, then this also could be an opportunity for them.
Very interesting ETF for sure. We'll leave it there. Dave, thank you so much for joining us today and for sharing your insights.
Thank you for having me.
That was Dave Maza of Roundhill Investments. Now let's quickly recap the ETF tickers that we discussed. The Magnificent 7 ETF is MAX, easy to remember. The Dividend Monarchs ETF is KINGS, the ticker symbol KNGS, and the Bitcoin Covered Call Strategy ETF is YBTC. These are all very unique ETFs. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.